that nothing in life is worthwhile unless you take risks. Nothing. Nelson Mandela said, "There is no passion to be found playing small and settling for a life that's less than the one you're capable of living."
Let's get into the real business of a trading plan. First thing we're going to talk about is the candlesticks. Candlesticks is the alphabet of the chart. I can't believe how many traders trade without looking at the chart. Somehow, they figure out there's an opportunity there without looking at how did the stock do in the past. And at least, even if you're not a technical trader, you can at least look at the chart to actually confirm your bias about where the market is going and what you're hearing in the news. Candlesticks lead and light the way to profitability. That's exactly what happens. Candlesticks will show you the way to profitability. Mark Douglas is one of the best trading coaches that ever existed. We lost him big time when he passed away a few years ago. Mark Douglas says, no man ever reached to excellence in any part or any art or profession without having passed through the slow and painful process of study and preparation. Studying the chart is going to actually make you achieve excellence. After a few losses, the wins will come. What are candlesticks? Candlesticks is the history of the candlesticks goes back to like the 18th century in Japan. That's why they call them Japanese candlesticks. I guess an investor called Huma was a Japanese businessman, and he invented this technical tool right here that you see right there to gauge the potential price of rice before entering into a contract to buy or sell rice. He discovered that the rice market sentiment changes according to supply and demand, and every time it changes, he put it on a candlestick. He invented that graph to show where is the sentiment, and based on the sentiment, he would actually either get into the contract or not. This method now is pretty much widely used in stock trading. It predicts market sentiment. It does not predict future movement. It just gives you the market sentiment and possible price changes of the stock. There's a huge difference. There's nothing in the market, nothing on the chart. Nobody knows where the market is going to go next. But based on where the price have been, you can at least make an educated decision to enter or exit that trade based on the memory of the market. Just like we said, the market have memory. How does the price form the candlestick is a very important part of how to read the chart. Each candlestick represents like a battle fought between the bulls and the bears, the buyers and the sellers. At the end of the day, the time frame, let's just say we always use a 5-minute time frame in all of our trades for daily trading. Every 5 minutes, where did that bar start, where did it end, is going to actually decide, is it bullish or is it bearish, right? When the candlestick closes above the open, the bulls win, producing the green bar or bullish bar, which means the market is bullish. The sentiment is bullish. When the market closes below the open, the bears win, producing the red bar or the bearish bar, which is this one right here. As it goes down, the sentiment is going down. Every candlestick shows you if the market is bullish or bearish, and therefore you can actually decide, are you going with the market, are you going against the market, or you're staying neutral like here. Once the candlestick finalized, once the 5 minutes have passed, this is how it's going to look on your chart. It's going to have an open price. This is a bullish, of course, bar. This is going to be your open price, which is below is going to go up, down, up, down, up, down, up, down until it closes at the price at the close. On the opposite, the bearish one is going to start high and it's going to go low. So you have the open price, you have the close price, but in the same time as the bar is going up and down, this is going to go to the highest part of the candle, this is going to go to the lowest part of the candle. The wick, this is what we call it, the wick. The wick is still part of the price of the candle. It's very important. A lot of people dismiss the wick or the tail. This is a big mistake that most traders do. The wick is still part of the bar. So on that green side, if the bar is green on your chart, of course, the bulls won the battle and the stock is trending up. On the other side, the bear win the battle if the bar is red, and you could say the sentiment is bearish market for that particular time frame. Do not try to jump between time frames. I've seen people have 12 different charts. I've seen people having the 2-minute chart, the 5-minute chart, the 15-minute chart, the hourly, the daily, the weekly, the monthly. I have even seen mentors teaching people that they should have so many different charts, at least 6 charts in the front of them to confirm. They call it like different time frames in alignment. And this is the biggest mistake they have ever done, because when one chart is trending up, the other chart is trending down. When one time frame says buy, the other time frame is saying sell. It's going to confuse you, it's going to make you hesitant, and it's not going to work out. Choose the time frame and construct your trading plan based on what that time frame is. If you say, I'm going to put my stop below the trigger bar in a bullish trend, that's where you keep it. If you look at the 15 minutes and then 15 minutes says sell, now you have a problem. So you need to keep one chart. The most effective, the most reliable time frame for day trading is the 5-minute chart. If your mentor's telling you trade the 1 minute or the 2 minute, he is entertaining you, because he's going to keep you busy fighting bar after bar. It's all noises. It's the 1 minute and the 2 minute and the tick chart are all noise. Things like the 15-minute and the hourly work, but the risk might be too large for your risk tolerance. You may not want to lose $5 per share. You may want to just risk $1 per share. So the 15 minutes might be too big for you. So, but if you can stomach that kind of risk, you can go to the 15 minutes and the hourly. The higher the time frame, the more significant the move. The higher time frame, the more reliable the move. Which means, it's better to go to a higher time frame, but at some point, the risk is not going to be too large for risk tolerance. For day trading, a 5-minute bar presents a perfect risk to reward ratio within 1 day. Okay, we spoke about the alphabet of the market is the candlesticks. There is only 13 candlesticks that ever exist on the chart. For this particular session, we're going to talk about just 2 of them. Okay? The most bullish and the most bearish candlesticks. What you see here, are these 2 right there. What you see here, we're going to talk in other videos. If you follow us and join our community, we're going to show you how to use this one, for example, to either short or go up. What's the difference between a long wick bar and a shakeout bar? Some people call it long tail bar. Every candlestick shows you an opportunity to either buy or sell, and we can work you up all of these to use these candlesticks. But for this particular video, not to make it too long, we're going to just talk about the most bullish right here and the most bearish right there. The wider the distance between the open and close, the greater win or loss. The bigger that particular bullish bar, the higher the sentiment. People are buying. There's a lot more demand than supply. The longer the bearish candle right here, the higher the supply than the demand, and therefore the market sentiment is bearish.